Hold harmless disclaimer. The content provided by Full Throttle Forex and or subsidiaries of Full Throttle Forex is for informational purposes only. The Full Throttle Forex, I should say Full Throttle Forex and any or all of its members are not qualified to provide training, trading, financial, investing recommendations, suggestions, or advice. In no way are the speakers or guest speakers performing in advisory capacity. All right, this is for informational and entertainment purposes only. You must conduct your own research and analysis. This allows you to be completely responsible for your decisions on whether you should trade in the Forex marketplace, either with software trading or manual trading strategies. Your attendance on any Zoom call or social media live event is an acknowledgement that you agree to the above statement and that you agree to hold harmless Full Throttle Forex and its subsidiaries. So let me stop the share on that screen and let's do this. Since we're in this webinar format, and Don has mentioned that last night he went to bed and woke up this morning and got the shaft, I'm going to allow him to talk right now. So Don, tell us why that is and what trades you're involved in that went the wrong way, obviously.
Yeah, can you hear me okay?
Yeah, I hear you perfectly, brother.
Yeah, I'm on the CHF, ring.
Okay.
And let's see, let me look over here. I'm going to look at my account.
Myra likes to refer to it, the ring of despair.
Yeah, that's what it seems like overnight. It was doing really well yesterday, but right now I'm negative $151 on a $5,000 account, and that happened overnight. I was ahead yesterday.
Okay, and what kind of positions are you in? Sell or buy?
Oh, they're almost all sell.
They're all sell. And yeah. What are the pairs? USD CHF?
The USDs. I've got the CHF JPY, USD JPY, and the USD CHF.
Okay, so you're selling in two positions against the US dollar. So, all right, well, thanks for your participation.
Okay.
I'm going to mute you back out and we're going to deal with this. So you guys, if you do have questions, hey, Steve, welcome to the call. Sean, welcome to the call. Gord, welcome to the call. I'm going to mute you back out somehow if I can figure this out. There we go. And I'm going to share my screen and I am going to, can you guys see my screen? Can somebody give me a thumbs up here? Yep. Okay, great. All right. So let's pull up a browser window. Hey, this is an insight as to what's coming later. All right. And let's go to investing.com. Now there's a bunch of tools out there, but I'm loving this investing.com in case you couldn't tell. And now I'm going to go to my portfolio, right? Okay. And in my portfolio, I don't have this symbol, but I look at it often. I don't keep it because I don't monitor it much. But let's go to the IDX. No, that's not what the dollar index. I thought it was IDX. It's just DX. All right, there we go. US DXY, my bad. All right, so did we just add it? Yes, we did. And then let's go to technical. Looky. There is your cookie. All right, so across the 30-minute, hourly, 5-hour, and daily, it's a strong buy. What does that really mean? That means that it is trending upward because our economy in the US is getting stronger. So let's do this. Let's see what it is on a short time frame. Oh, strong buy. A shorter time frame, if there's one in there. Nope, there isn't. All right, let's look at a weekly. Well, let me undo the 5-minute and let's see what it is on the 15. Strong buy. All right, let's undo the 15 and pop a weekly. Strong buy. All right, so, and we could probably, I don't know that we'll see that same thing on a monthly. Oh, strong buy. Every single freaking time frame, 5, 15, 30, hourly, 5-hour, daily, weekly, monthly, says that our economy in the US of A is growing like a weed. All right, let me apply that there. Okay, so you can follow that on your phone, you know, the DXY, and it will tell you what's going on with the US economy. Now, the fact that in Don's situation, he is trading against the US dollar twice in sell positions, but the trend, quote unquote, the trend is your friend, that sort of rigmarole, right, is gonna be getting into some drawdown here. And it doesn't look like there's any end in sight, according to what the strong positions are in the dollar index. It just seems to be getting stronger. Now, that does not mean because you're trading with Trade Ringer here that you're going to go in and close those positions and take a loss. It's an option. I don't know that I would do that. Okay. But it does give you some idea as to what's going on. So let's go ahead and go out to tradingview.com. And I wrote these down, but I know one of them was the USD CHF. So let's just pull up a chart and let's take a peek at, oh, look, I already have it up. All right, the USD CHF on a daily. All right, let's look at it actually on a 4-hour, a little bit less of a time frame. And I know this is normally Ryan's thing, but I do know how to do this fairly well. So let's take a peek at what's going on. Obviously, if we grab a trend line, we can see what is happening, right? Okay, I mean, it's pretty simple to see that the trend on a 4-hour, and that's quite a number of, you know, quite a number of 4-hour candles, is by far and away up. Actually, if we take this and, whoops, didn't mean to do that. Let me delete that one. Sorry about that, you guys. Now you know why I let Ryan do it. All right, let's go back here and redraw since I hit the delete button and go from the bottom to the top. I mean, it's a super big trend up, right? And it doesn't seem like there's any end in sight. So let's take a look. Let's go back to the daily, and we might even go to the weekly. I mean, look at what this thing has done over time. I mean, is the US dollar blowing it up or what? I mean, yes, is the answer. The US dollar is blowing it up. I mean, that is a super strong trend. So let us do this and try and figure out. It is busted through tons of resistance. So we're going to switch to even a higher time frame, weekly. Now, why am I doing that? So I can see more stuff. You guys, this thing is in no man's land. Look at this. If we go left, we don't see this price anywhere. So let me just look at this real quick. I'm going to draw another trend line. This is why you guys should have this tool. This tool is unbelievably good. So I am going to draw a horizontal line. I'm going to just pop it. Oh, I don't know, right there, just for fun. Oh, it's yellow. All right, well, whatever. And now we're just going to start going left to find out. And I don't even know that we're going to see it. I'm going to go like this. Is the dollar at an all-time high for a long time or what? Yes, because I think the chart's way down here. It's ridiculous. So we can only, if you're in sell positions against the US dollar, and I'm sorry I'm moving the chart around so much. I know that's not comfortable on the eyes, but you know, here's the thing. So this being a weekly candle, let me switch back to something that we're trading, and that would be a daily. All right. And let me blow it up a little bit so we can see it better. Here's the good news. All right, I don't know where your trades got placed, but let's just pretend for a minute. Put a horizontal ray in that your one trade is there, right? And you have another trade maybe here or whatever. We don't have to get all the way back down here for a retrace. All right, as a matter of fact, I don't know if you carried them over from last week or not, but this is today. So this is Wednesday. This is Tuesday. You know, and you can see some loss of momentum here. If you guys are studying price action, which I hope you are, because it's an important part of what we're doing. All right, and let me blow these up just a little bit. Oh, I keep putting rays on the field. All right, we don't want to do that. Okay, we can see there was big momentum right there. Momentum got a little shorter. Momentum got a little shorter. Bears tried to push it down. Bears tried to push it down again, but and you can tell that because the wick's on the bottom. Hopefully that makes sense. The wick is on the bottom, and that tells you that the price was there at one point, which would be what? That would be a candle because this was the open right here. This line right here was the open. It actually went down and it looked like it might do a bit of a reversal, but the bulls pushed it all the way back up. In fact, it was a little bit higher. And then we go to the next candle and the bulls tried to really push it up. Bears said nope. And so it started to lose a little momentum. Opening price was right there at the bottom. It went all the way up here, went all the way up here. Actually, it started down a little bit. And we have a little bit of choppiness here. Good day if you're in the bear position. Good day, better day if you're in a bull position, right? So you guys can see kind of the momentum in price action right here. And, you know, that'll help you understand what's going on. So right now, we had an open right here, and it is currently on an upward trajectory. The good news is if all, you know, you got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days, 11 trading days, 12 days. You might find yourself, if you are on the sell side of a US dollar trade, hanging on to trades for a little longer term. But please understand, long-term trades, while not fun, because everybody's worried about how that's going to affect their count, are pretty normal. That's why there are weekly and monthly timeframes. There are guys, and of course we're not institutional traders, that will place a trade already in mind with a monthly, they're going to leave it for a month. Now they may have a direct liquidity feed or something like that so that they're not paying swap fees to a retail broker and stuff like that, because that makes it difficult, more difficult for us to be in a long-term trade when we get charged interest, which is called a swap fee, every time a session goes from New York to Tokyo to, you know, to Australia to London. That's what those fees are for. They're actually interests they're referred to, but you can learn all about those on your own or in another lesson. So that's one of the reasons why we're seeing what we're seeing on Don's chart. I just wanted to point that out. The dollar is going absolutely ballistic. So let me unshare my screen real quick. And we've got a couple of questions. I've got a slide share that I definitely want to share with you, and we'll do that in just a second. Don's question says this. So since we're on to Don, our demo accounts react to the market in real time, correct? If there were millions of people using demo accounts, would that activity in any way affect the real market? First of all, when your market is $6.6 trillion a day, unless you're moving billions, and I mean billions of dollars at one time, you're not going to affect the market in any way, shape, or form. Whether demo accounts were trading in real time, which they're not moving the market at all or affecting it in any way because there's no real money exchange, right? But only a George Soros or some other guy that is just a massive currency trader, you know, could have that kind of an effect on the market. The market's so big. I mean, I promise you, we're an amoeba in the ocean. That's the relevant size. A grain of sand on all the beaches of the world. We have zero impact on the market. So, and to answer your questions, react to the market in real time? No. Demo accounts do not perform like live accounts. I know there is some, a bunch of people's eyebrows just went up because there's no execution time. It's very close. Okay, you get to see how the trader works. You get to see what the potential outcomes, if you were trading live, would be. You get to learn how to use your skills and strategies, whether that be software, manual trading, or whatever, using a demo account. Does it respond in the same way as a real account? No. And the reason for that is that there literally is no execution of the trade into the liquidity provider. That's the only piece that's missing. Okay. And we're talking, nanoseconds. We're talking milliseconds, I should say, not nanoseconds, but we're probably talking milliseconds. So it's not a big difference, but it is different. So to answer your question, real time, no. The only way to get real time data is to trade real time money. But I want to put everybody at ease here, and that is that you can use your results in a demo account, and that's why we use them, to gauge the performance of how something is going to work, how an idea is going to work, how a strategy is going to work, how any particular piece of software is going to work. So don't fret about that. Oh my gosh, I'm having great results on my demo account. It doesn't translate to my live account is not the case. I promise you. Okay, so don't worry about that. All right. Hernan says, hopefully that helps you with that answer. Let me dismiss that one. Hernan is asking this question. Is there a setting that affects the depth of the order? Depth of the order. Try to re-explain that one to me, bro. I don't know exactly what that means. I know you do, so re-explain it. And then distance. The distance of the order. Are we talking about? Okay, I'm still not getting it. Let me let you speak, because I'm not really understanding the question and I want to answer it. Hang on one second. I'm not sure which Hernan Lawless, the Gmail one or the other one. I'll try this one. Is that the one? Can you talk? No. Can you unmute yourself?
Okay, how about now?
Yes, sir.
Okay, so when it places an order, the order is so far away from where I'm at. Is there an adjustment where
what do you
when
mean?
it places an order, it's not going to be so far away?
All right, so when it places an order, so a trade, a position opens, right?
Yeah.
Okay. And when you say it's far away, what part of it? The take profit, the stop loss, the
both. Is there a way to adjust it so it's closer to where I'm at?
Yeah. So every single order that gets placed by TradeRinger has a 253 point stop loss immediately. That's the default setting for TradeRinger. So every order, okay, so Sunday rolls around, you pop in 3 trades if you're trading 3 charts, and you can calculate the stop loss from your entry point by doing the following thing. Let me just show you what that looks like, so that you can duplicate this. Let me share my screen. I'll go down somewhere in my life. All right, Microsoft Remote Desktop. Did you open, sir? Remote desktop? Yeah, okay, thank you. All righty, look at this mess I have going on. Fantastic. This isn't running, neither is that. I don't have any TradeRingers running. I'm not trading TradeRinger this week, just sort of looking at some stuff. All right, but I do know some people that are, and I do have access to their accounts, and they're not on here for me to ask, but hey, we're going to use their account anyhow so that we can do this. Now, I don't know. She does not have this turned on. Fabulous. All right. That's Danielle's. This is Tanya's. And she doesn't have it turned on either. Pooh. All right. Well, I'm not going to be able to show you this the way that I wanted to, but let's go into the account history and let's look at something here. All right. Maybe we can figure this out. I'm going to have to put on my specs because I'm a blind fella. All right. So you guys, this window down at the bottom called the terminal window, you can see the name in this little gray bar right here. Everybody wonders where the name goes. That's it, right? In the terminal window, you'll see the order number. You'll see the order date and time down to the second. You'll see what type it is and what your lot size was. and what your opening price was. Okay, so you will be able to take that number without the decimal point. So in this case, 109,701. And if you were to jump right over to stop loss right off the get-go, okay, that would be in this buy position. Okay, this would be a stop loss would be the other way. So 109,701 minus 253, you would see a stop at 109,448. A 253 point stop. That is the default setting, and that's how you, now this one obviously is on the account history, all right, but you would see that in your open trade as well, all right, your opening price right there and your stop loss right there. And that's how TradeRinger's default setting is. Now, as the trade begins to progress and do things, it starts to adjust that stop. Now, I bet you there's a guy that I know that probably has figured this out. I haven't had any need to do this, but when does it make its first adjustment? I don't know. So it might be, 10 pips, 8 pips, something like that, where it starts to move that 25.3 pip stop loss or 253 point stop loss tighter to your trade. It may start to trail the trade by a certain number of stops, so that in case there's a market reversal, you don't lose what you've already gained. And that is what TradeRinger does. This is when your auto trader is turned off. All right. This is what you don't get. So if you were at a 253 point stop loss and you had your trader turned off, okay, on this trade, then no dynamic movement would be, would be happening there. The stop loss would not be being managed by TradeRinger. So for you, now to answer Hernan's question directly, could you get in here and modify that stop loss right off the get-go? Yeah, you could. But remember that TradeRinger is quote unquote a swing trader, counter trend, and it's more than the reason it gives itself so much room is because it knows it's going to go in that direction, and it's going to get in a bigger drawdown. It's just the style of trading that TradeRinger is, and it makes once in a while it gets into a series of trades that makes people nervous. Now, as far as Don's position goes, to be $100 drawn down on $5,000 accounts, nothing, peanuts, right? No one wants to see it, but it is peanuts. So that's one of the reasons why, that pip count is so big. Those points are so big. Now, since you said both, okay, the take profit is also determined dynamically as the trade develops. And so if you mess with those things and you don't keep your ratios the same as more positions are entered on your trade, there's just a really, really big chance that you're going to mess up the algorithm's mathematics all the way together, and you're going to have an outcome that you don't want. So the bottom line is here, let me stop this share. The bottom line is here is that you have to trust the way the software does math, because it knows what it's doing. Okay. There's no chance in the world that every trade you have is going to be like whatever year it was the Dolphins went 16-0, right? You're never going to win them all. You are never going to win them all. And that's one of the reasons why we want to be conservative in our trading, so that if we do need to take a haircut on Wednesday, and I imagine there's a lot of people that will be making that decision later today, that you're in a position where you can do that. Does that help answer your question there, Hernan?
Well, my question is the default percentage. Is there a way to change the default percentage where it doesn't go out so far?
No.
Okay. All right. Because I don't want to mess with an individual trade once it's been placed. But I was wondering if there would. Yeah. Okay. All right.
No.
I got you.
No. There is no setting that does that.
All right. Thank you.
All right, you're very welcome, sir. All right, let's move on to the next question. Distance so far. Okay, so we've got all of those now that I understand what the question was. Perfect. And I'm going to share my screen one more time. I've got a little slide presentation here, and this is based on, and I hope she's on this call. She may not be. Let me see where are my participants here. I created this training. Hey, Jim Woodman, what's going on? Specifically for Carol Sewell. But I believe that everybody can get a lot out of it. So maybe she'll catch the replay. So let me share my screen again. And if there aren't any questions after this, this will be the swan song here. All right, and let me pull this up. All right, so there was some questions last week about, and I'm going to close a bunch of windows here. Otherwise, when I'm in full screen, I won't be able to see this. There were some questions last week about what's my margin, what's my this, what's my that. And so I created this training so that we could understand what the trade tab, and you can see it down there, it's highlighted in red. This is a screenshot of an account that I am currently trading this week. All right, doesn't look so fun, does it? Doesn't look so bad. But I wanted to use this account screen because it's got a lot of components on it that will make this training very, very good, I think. So what we're going to learn here is the current account disposition. What does the balance mean? And you see that at the top of the screen right underneath the big red bar. What does the equity mean? What does free margin mean? What does margin level percentage mean? And what are current positions? So let's dive right in. All right, the first thing is we're going to ask ourselves, what is floating profit and loss? Now, some of you may know this. I know I've got traders on here. I've got new people on here, and so I want to just cover it, everything. All right, so floating profit and loss is what is shown in the section above all else. So that minus 804.79, okay, could it be red? And it is red in this case because it's negative. Or it could be blue, and it is blue when it's positive. So if the total of your current open positions add up to a negative number, it's going to be red. And the number represented will be the sum of all open positions. And you guys can see there from my phone screenshot where the positions start right underneath margin level percentage. Okay, so it's a sum total of all the open positions, both positive and negative. Now, this number also includes, this is super important if you decide to do this math. And I've got a screenshot that'll show this. This number also includes any commissions due to the broker and any swap fees, aka interest, due to the broker. Many refer to this negative number as the drawdown amount. Well, what happens if it's not drawn down? And what if it happens if it's blue? It can't be drawdown. Some people have referred to it as draw up. There's no such thing, okay? But there wouldn't be any drawdown on the account. So if you want to talk like you know what you're talking about, this is actually called your floating P&L. Why is it floating? Because it's constantly on the move. Okay, it's 804.79 now. It's 702 an hour from now. It's floating in the marketplace. So in reality, if someone were to call and talk to you about trading and say, what's your current floating P&L? That's where you would get the number. Some people call it drawdown, like I said, and that's fine. Okay, when it's red, it is your account is drawn down. Hopefully that makes sense to everybody. So that its real name is called floating P&L, which is why when you're in TradeRinger, you see a current floating percentage and a current floating, because it's floating. All right, it does not become realized until it's closed. Hopefully that helps. All right, the next thing we're going to talk about is what does balance really mean? So let's take a peek. All right, balance on this account is 3824.74, and the balance that you see in that top portion of your trader is a reflection of the amount of money that is currently in your account. Flat out, super simple. It should be noted that this does not include any open positions. Okay, this includes both positive and negative red positions, obviously. Okay, that you see in the positions, quote unquote, section of the screen. And if you were to perform the math, it would look like this. You would simply add negative 125 to negative 130 and so on and so forth until you got to the blue trade. You just wouldn't put a minus sign in front of it. And the answer you would get is negative 739.10. Oh, wait a minute. How come it's negative 739.10 and not negative 804.79? Remember, the thing at the top, the floating P&L at the top, includes commissions and swaps. When you add up your current position, it does not. So the difference that you see between the top screen and the math we just did is the amount of commissions and swap fees going to the broker. So in this example, if you opened every one of those trades and, by tapping on them and looked at the swap fees and the commissions, wrote them down, added them up, they would equal, in this moment in time, $65.69. That's why the math is different if you add all your positions and then you look at your floating P&L at the top of the screen. So your balance, again, is the amount of money that you currently have in your account, and it does not take into consideration in any way any floating P&L. All right, there we go. So there we go with balance. The next thing we're going to cover is what is equity and how is it calculated? Super simple. The equity that you see at the top portion of the screen can be calculated using this formula. Your balance plus your floating P&L, that would be the 804, equals your equity. So 3824.74 is the balance, as you can see, okay? Plus negative 804.79 equals 301.995 on the nose. So it is your balance, current, plus your current floating P&L is what makes up your equity. Your equity would be what you would be left with if you closed all current open positions. This is critical because in this account, I would go from my current balance of $3824.74 to almost, over an $800 loss, about $805. So would I want to do this on a Wednesday at 1 if this were my position? Well, that's more than I want to eat in a week. So for me and my trading plan and my trading style, that would be a no. But that's how you calculate that. And this is what you need to know when you're making a decision to exit a single trade. Now in TradeRinger, we're not doing that, or exiting out of the market on Wednesday because it looks like the market's going in the wrong position. Hopefully that makes sense. So that's how you calculate your equity. Balance plus floating P&L equals your equity. Super important calculation to know on Wednesday at 1 o'clock because it should make your mind up for you. Okay, next, let's talk about margin and why you need it. Okay, so the margin that you see at the top of your screen is simply a good faith deposit to open positions or a position. Okay, contrary to the popular idea, margin is not a cost of transaction. That is not what it is. Okay, when the position closes, the margin is added back to your trading account. It's not a fee. Margin is determined by your lot size and your account leverage. So here's an example. If you open a trade with an 01 lot, the broker is going to place a good faith deposit on your behalf, and it appears in that margin section. Now, with so many trades open on this particular screen, the 1152.70 is a representation of all the good faith deposits for every one of those trades. All right, even the blue one. All right, even the blue one. That are currently open. Now, if I only had one trade open, this would be easy for you guys to be able to see, but that isn't the case here. So what happens here, more positions means more good faith deposits, obviously, and the margin amount increases proportionately. But if we had one trade here, what you would be able to see is certain currency pairs like Euro USD is probably 2% of the trade amount based on the lot size and the leverage. More obscure trades cost more money. That's the truth. They cost more. Well, they don't cost more money. They require more of a percentage of your margin, your balance, your deposit, to be able to place. And again, it's just money that's set aside to cover a loss for the broker. Okay, so if your lot size was increased to 02, the good faith deposit to open the position would be simply double. 03, triple. And the margin amount does not change during the entire duration of that trade, regardless of how negative it gets or how positive it gets. I shot a little video of this screen actually so that you guys could see it. Now there's no noise on this video, but take a look. I want you to stare specifically at the margin in this video. As all the other trades are moving, what isn't moving? The 228.86, not a dime, nor will it. Not a dime. See, no matter what happens down in the positions, the margin stays the same. That was the good faith deposit that the broker took in order to place all the open positions that I currently have on this manual trading account that I'm trading. Boom, done. All right, so hopefully that helps everybody understand what the margin is. Okay, now the free margin. Whoops, I forgot to change the header here. All right, so the free margin that appears at the top of your screen is the amount of money that you have left in your trading account so that they can be used. It's free to be used. That's why they call it free margin. Free to be used as good faith deposits to open more positions. And the free margin is calculated using the following formula. You take your equity and you subtract your current margin. So in this case, 30195 minus 1152.70 equals 1867.25. Just like it says in the top of the screen. So that is all free margin is. You want as much of that as you possibly can get. All right, free margin large, that's what we want. Okay, now this is the one that confuses everybody, and it confused me as well until I did this exercise, to be honest. Okay, what is the margin level percentage and how is it calculated? What in the world does that mean? 261.99%. Okay, well, it's another one of these things that we want to see as high as humanly possible. So the margin level percentage in this case, 261.99, this is another an account metric that you want to see as high as possible. Like I just said, if your margin level reaches 100%, okay, the worse shape your account gets in, or the more negative floating P&L you have, the closer to 100% your account will come. You aren't going to have any free margin left. Okay, so really, you won't be able to open any new positions until you close some existing ones or until they're closed or stopped out. And this is how it's calculated. Your equity, in this case, 301995 divided by the margin times 100. The equity divided by the margin times 100 will get you that number every single time. It's actually 261.98, which is rounded up to 99. Okay, so here is an actionable item for everybody. I know everybody, we bang on you to go, take some time and read Baby Pips, and I know some of you are. If you really want to understand this, and some of you will and some of you won't, and that's okay, no matter which faction you fall into on that, but there's the link to do it. babypips.com/learn/4/forex/what-is-margin. It will teach you everything you ever wanted to know about margin and more. Why they call it margin, why you need it. I mean, it's a great, great lesson to better understand what you're looking at. And guys, let me just say this, all right? If you are a real money trader, get educated, please. Or if you prefer not to get educated, my address is 2720 Aragon Court, Thompson Station, Tennessee, Send me your deposit because you're going to lose it anyways if you don't educate yourself. And I could use it. All right, so there we go. That is your margin level percentage. Now, what I didn't get into in this lesson that I may get into next week on Monday or maybe even Saturday is what a margin level call is. Okay, it's interesting. This was the part that I was confused about. When you hit 70% at the broker that a lot of us are using, that's when you get margin called. It isn't 70% of your account in floating equity. It's your margin level percentage when it hits 70%. So they will actually let you trade past 100%. You can't open any new positions, but when that bad boy gets 70, that's when you get tapped. Okay? So it comes in backwards, which I never understood it to be that way. So again, the babypips.com lesson is massively important to understanding how the broker works and why they do what they do. So I think that's the last slide. No, it isn't. What are positions? Great. We got one more slide. Fantastic. Well, now you see what I was pulling off the internet to use as an image. Positions are super simple. It's just a reflection of the number of open trading positions that you're currently involved in. And I know that you know, most of you, if not all of you, already know that. Your open trading positions are what make up your floating P&L that is often referred to in conversation as drawdown, but it is truly your floating P&L. And when you're talking with customers, when you're talking to somebody who knows anything, when you're just having a general conversation, and they say the following words, I'm losing $804.79. Wrong answer. Your current floating P&L is negative $804.79 is the right way to term that. Because what if it was a positive $804.79? Your current P&L would simply be $804.79, and that would be fantastic. Now, the reason that most of us have never seen a positive 804 is because our accounts aren't big enough. But believe me, it happens. I've seen them. I've seen them well into the over 10 grand on the bigger accounts that are trading with TradeRinger. So it's crazy. Just remember, everything works in a percentage, and those larger accounts are fun to watch and scary all at the same time. So hopefully that helps everybody. I see that there are additional questions. Let me stop the share. And let me, man, my computer, I better reboot. Okay, so we got more questions here that I want to answer. Let me go to speaker view here. Am I the speaker? No, apparently not. Hernan Lawless is, look at that handsome fella. Hernan Lawless. Let me go back to gallery. I really have to learn how to use this software better. Okay, Nan says, on a demo account, $2,500 account with $100 drawdown today, would you keep TradeRinger trading into Thursday and Friday? I don't know. My trading rules look like this. $100 divided by 2,500 is 0.04%. All right, no. I would not. I would close it. It's a demo, though. So again, let's talk about that. I always speak. I like to learn my lessons on live accounts now. I do trade demos, but here's what I want you guys to have the proper mindset. Okay, the proper mindset is this: a demo account should be used to learn what not to do. Okay, it's not to learn what to do, and why is that? Okay, well, okay. For every dollar that you learn how not to lose, you're winning in Forex, because the wins are incremental. So a lot of times you'll see, a trade win that might be $2, it might be $8, $10, sometimes higher, depending upon your account size. But you'll see a loss that's like $30. And it's like, holy crap, based on the number of trades that I won and the average cost of trade, or the average win, that $30 loss just ate 16 of my trades. That's probably an exaggeration. Maybe 5, 6, 7, 8 of those trades. No fun. Losses and focusing on how not to experience them and being careful not to lose money is equally, probably more important than actually learning how to win. Trade Ringer knows how to win. You've got to mitigate the opportunity of losses by being careful with your account. And I just gave Nan props at the beginning of the call, and I will again. Numbers of times she has called me and said, I'm not trading this week. And being more conservative than even I. And I'm conservative, you guys. Here's the reason why. All right. And I know everybody feels the same that's on this call. Okay. I work hard for my money. It's hard to get, right? The last thing that I want to do is go take it out to my fire pit out back and set it on fire, and play a song on the guitar. That's not my game plan. My game plan is to grow it at a rate higher than I can grow it at a bank, in a mutual fund, in an annuity. And since those things are already relatively low, I don't have to outperform much, do I? Here's what my mindset isn't. Man, I can really learn a lot of money in Forex because the opportunity to trade in a $6.6 trillion a day market is massive, and I can capture some of that stuff, and so I'm all in. Yeah, no, that's playing poker. All right, that is playing poker. Not a good idea. There are very few professional poker players that can earn a living that way. That is going to be the same result that you get here. It's too cray-cray in the marketplace unless you are an absolute trading genius like a Steve Greger or any of these guys that have been trading for 10, 15 years. Imagine us as retail traders. January was my 1 year. I'm barely over 1 year. I wouldn't put my knowledge up against somebody like that, and nor would I compare my beginning to his end. The guy already knows what he needs to know. He's already got his trading style. He loves to trade, Elliott waves and Fibonacci retracements, and understands them and can spot them. It's like if you've ever seen the movie The Matrix, and the guy is looking at the screen and Neo's asking, you look at it in code. He goes, oh, I don't see the code anymore. I see blonde in a red dress. I see family having a picnic. Well, that's how those guys are when they've had so much time looking at charts. They spot the things they need to spot to understand. It's ridiculous. Skill that we all want to get. If, in fact, and I'm saying this way, if, in fact, you want to understand trading at a macro level. All right, so that is it. Apply your trading rules. And if you haven't set up trading rules, figure out what those are. Figure out that maybe, and let me give an example or two of what I mean by trading rules. Maybe you say to yourself, well, I socked away $100,000 into an 8% annuity over 10 years that is going to pay me an annuitized payment of X over time. Okay, what a formula, right? And I want to outperform that, which means that I need to earn whatever I need to earn, and I'm not even going to try and speak that bad boy, but I need to earn whatever I need to earn to outperform that. Write that down. What does that look like? Maybe that's only 1% a week for you. Do not be drawn in by FOMO because you see all these people posting, man, I got 7% this week. Okay, here's what you don't see them posting. Wow, I took it in the shorts and lost 15% next week. You don't see them posting that. I promise. Okay. Unlike the regular news, or some people like to refer to it as the fake news, only good news sells in Forex trading. Bad news, sweep that bad boy underneath the rug, right? We don't want anybody to know about the bad news because we don't want to admit that our software failed. We don't want to admit that our trading strategy may not have been the best or anything like that. But man, when it wins, shout it from the mountaintops. Be very wary of those kinds of things, right? So what do you need to do? You need to figure out what makes sense to you. Look, all day, every day, would you not take 20% a year on your money? Please. You're not getting it anywhere else, right? And if in 52 weeks I need 20%, what is that? 20 divided by 52? I just need to average, 0.3%. It's peanuts. So guys, put your trading plan together and stick to it, which means, Nan, when you come to that point of being able to take yourself out, it is a demo. Have fun with it. Learn what not to do. Prove to yourself by taking that $100 drawdown today and letting it run through Friday that that is probably a bad idea, especially on TradeRinger. Okay, let me make this point too. And I know I'm going on a little bit, but you know, these questions are good. These points are good as well. Before the relationship with Bolt, which is the software company and the group of traders that built TradeRinger and its algorithm, they traded it for 7 or 8 years. I don't know the exact number of days or months or years, but it's around that time period. Okay. So they have a lot of historical data. You always hear Ryan refer to it as looking left. Well, they can look left for 8 years approximately, right? Maybe 9 now, because heck, it's been around for a while. 8 or 9 years. They can look to the left and gather historical data on which to base the probabilities going forward on, because these things happened. And that's why when you're looking at someone's trading account, there's no guarantees that they'll continue to win, that they are, because no one can tell the future. But what you can do is look to the past to know what the cause and effect was. Like the following. The last time I went skiing, I didn't have a very good time because I'm out of shape. Now that's not something that I'm projecting that, which is bad. But I used to ski an awful lot. So maybe I could say, you know, maybe I don't want to go skiing anymore because I just, you know, I'm getting older and it's not as fun for me. That is me being able to project based on history. Trading is no different. Based on history, they are able to do that. So that's the way you want to kind of sit down and go, okay, let me think about what's really important, because no one, and here's the challenge. Now, this is what's going to really sort of throw a wrench in the monkey works. If you're starting with a $1,000 account and you're only going to try and get 20% a year, exciting? No. Don't let the excitement level or lack thereof be your guiding light. Try and figure out a way to get a larger account if you want larger returns. That's what I would say to that. Okay, so we're going to move off of that. And can I post the PDF? Yeah, sure. Actually, what I'm going to do, Hernan, is I am going to peel this out as a separate training video. The part that you can have the slides, you can, you know, do whatever. I create slides all the time. But I am going to post this as a video by itself. And I may go back through it just to make it a little bit cleaner. So yes, I'll be happy to do that, and I will do that today. Nan said, you mentioned more obscure trades. What would be considered an obscure trade? Literally like the URL, the Euro CHF is not a Forex major. Remember, Forex majors all have USD as part of their component. Forex miners, to be considered a Forex miner, there is no USD involved. Then you have your Forex crosses, which are even more obscure. That might be like the South African Rand versus the New Zealand dollar, or New Zealand dollar. I don't even know if that's a real pair. All right, but it could be something like that. That's a more obscure, not traded as often. So see, the Euro USD is the cheapest because there's so much volume. The more volume, the easier it is for the broker to justify the expense of allowing you to trade it. The less volume, they're worried about their money. All right, so that's what I mean by more obscure pair. And it should be, I should have said more obscure pair to have the vernacular be correct. It's not really a trade, it's a pair. All right, so that is done. Nan George, another question. And I better put the glasses on for this one. So at 261.99 margin level percentage, TradeRinger will not open any more positions until, no, that isn't what I said. If that 261.99 were to reach 100, then TradeRinger could not open any more trades. With it at 261.99, there's plenty of room for more positions. So when your margin level percentage is at 100%, think about this, even though we're backing into it, right? We're backing into it. That's what makes it difficult for people to understand. It doesn't start from 0 and go to 100. It starts from somewhere up here and backs down into 100. So when your margin level percentage is at 100%, that means you have used all of your free margin. It is gone. It is all involved in open positions. Now, if you were to close a position, whether it was a positive position or a negative position, remember that the good faith deposit called margin that the broker put into your margin, that margin line, okay, is then going to be released back into your account. And guess what? Your 100% will go to 110%, 120%. Now you have about 20% margin to play with to open another position. Hopefully that answers that question. What was the reason for your not trading? Was it the banks being closed? Great question. All right. So that was part of it. For sure, that had something to do with it. Okay, I'm trading the Euro JPY, Euro USD, and USD JPY. So two of my pairs had the US bank involved in it. The banks were closed. And then I looked at today. Today has been an onslaught of red folder and orange folder events. There's a bunch of orange folders stacked up to a couple of red folders. And so for me, there was no Sunday availability, which there never is anyways, okay? If our banks are closed from 4 p.m. or whenever the market opens until tomorrow morning at 8 o'clock when the banks open in the U.S., we don't have the benefit of the U.S. liquidity. But please remember this, okay? This has got to be in your head. There are 10 what they consider the top 10 liquidity providers in the Forex market. In the $6.6 trillion market, 5 of them are U.S. banks. Half of the top 10 liquidity providers were closed on Monday. All right? When there isn't a lot of liquidity, there's the potential for a lot of volatility. I'm out. I don't care about it. Now, if I was a spot trader, I might want to take advantage of that. Spot trading means manually, placing a trade at a time. Okay, but for TradeRinger, no good. I don't want it to get in positions going the wrong way based on lack of liquidity, blah, blah, blah. So I combined that issue in my mind with the news on Wednesday, and just the week was just shaping up to me to be just not the best week to trade. So I didn't. Let's see, Hernan. Who set the default settings we see when setting up the new pairs? Yeah, are you talking about, I think I know what you mean, Hernan. So when that setting, when you launch a new pair and you go to the settings and it says 100%, can you give me a thumbs up if that's what you're talking about as a goal? Yeah. Okay, so that default template is a combination of faults. Hand up, and also the gentleman who is missing today. And that came from the Miami event a long time ago. The reality of it is I need to get in touch with the owner of FXVPS and tell him we want something different. Yeah, it's important to change the default template now because it was set up to do something different than what we're doing now. All right, Kay Davies is asking a question in the chat. Let me get to that. She's asking, why set equity protection at 65%, not 75% or 85%? Well, there's no good reason, really. And that choice is yours. So the equity protector, let's just look at the equity protector. Okay, so I can say this to you, Kay, because you actually have a few years on me. Hernan will appreciate this as well. All the old guys, all the old folks in here will appreciate this. Okay, you remember when we were all in elementary school and we had that drill that would go on and we had to get under the desk? In California, that was considered an earthquake, but there was some wartime stuff there that took place too. Kind of a doomsday setting, right? Is what the equity protection is. And look at it like this. There is a great video on YouTube. In fact, let's go. Let me get this video link and post it. It has nothing to do with Forex trading, but it has something to do with trading. Let me go to YouTube. I think I can find it in a heartbeat, and then I'll answer your question. All right, let's call this the Flash Crash May 6, 2010. And that's not it. That's not it. I think that's it. I believe V-Pro documentary. Give me 1 second, you guys, because this is really good and you'll enjoy it.
Really made it work. The engineers, machine.
Yeah, this is it. All right, let me share this URL. Copy. All right, I'm going to put this to everyone in the meeting in the chat. Copy that URL, you guys. It's about doomsday. It's about when the market does something that no one saw coming. And this actually happened, so it's very interesting to watch. And you guys heard Ryan refer to the other day how brokerage firms, how trading institutions will fight for an extra 1,500 feet to be closer to the servers, to have a shorter travel time. It came from this video because they talk about it in this video. So the equity protector is to protect yourself against catastrophic loss. Now, a lot of us would say this: if I have a $1,000 account and I set my equity protector at 65% and I lose $650 because that's how that calculation would work out, of my $1,000, that's catastrophic. No, it isn't. Okay, your mortgage is more than $650 if you even have one, right? If your house isn't paid off. Your car payment's probably more than $650. Losing $650 isn't a blip on your financial radar screen, so don't act like it is. It isn't. Not fun. I don't want to waste that money. Nobody does. But it isn't catastrophic. But if you had a $100,000 account and you got soaked for 65 grand, oof, that's a lot. Okay, but here is why we set it at 65. You could set it at 50. You could set it at 75 or 85. A lot of traders set it at 100, which then allows the broker to do what they do, right? So you're basically turning it off when you set it to 100%, meaning that you don't want it to ever kick in. Okay, you're going to give your account the most room to work that is possible. When you set it at 65%, conversely, you're allowing 65% of your existing balance to be available to be floating P&L. So when you set it at 65%, you're allowing 65% of your current available balance to be considered for floating P&L, and in a negative way. All right, so let's just talk about, and you might call that drawdown. All right, so that means that in a catastrophic event, and we'll just use, let's just use the easy math and call it $1,000 account. If there was something like that happened like in this YouTube event and related to the Forex market, not the stock market, you would at least be left with $350 in your account. Whereas people that did not have a setting, or who had set it to, like a lot of people in that flash crash and in 2008, lost 100% of everything and more if they were leveraged, right? Highly leveraged in the marketplace. So the idea behind the setting is that you put it at some level that you're comfortable with losing. Right? There's that word. None of us like to say the L word. Now here's something that you need to know about that setting. If you set it too low, for sure you're going to tap out. Did it? All right. When we first started learning about the software, there was nothing that told us where to set it. We had it, the default setting was 20%. How many, by show of a 111 in the chat box, have seen drawdowns larger than 20% during their time trading with TradeRinger? Let me see it. Yep, Nancy too has. Nan George has. Who else? Anybody seen a drawdown? Yeah, many ones. Gord's has seen massive. 5x5 from Hernan. Right, see? So let's just say that you started with a pristine $1,000 account, Dr. K, and you left that set low like that at 20%. The moment that your floating P&L reached 20%, the nanosecond that it went from 19.99 to 20%, every open position in your floating P&L, whether they were negative or positive, gone. TradeRinger would shut them down. You would take a $200 loss or thereabouts, 198 to 205 probably, depending upon market execution time, and your account would be shut down for the week. So setting it too low doesn't give TradeRinger the room that it needs in order to flex in and out of the marketplace. That's the reality. The higher you set it, the more room you're giving it. Okay. Now, here's a contrarian statement to something that we have been teaching that I now learned was incorrect. Setting your equity protector at 70% is not the same. And Myra, this is explaining a lot on what happened to your account. Is not the same as the 70% margin call that you have, because you're not at 100% yet. Remember, when you're backing into the 100% number, instead of going from 0 to 70, you're going from, whatever it is, 1,000 down to 100. It's a different number. 70 becomes a different number. 70 is actually on the negative side of 100 at that point, where it's on the positive side of 0, meaning that if you set it to 70% and you hit it, you'd still be left with $300 in a $1,000 account. But that is not the same as the 70% margin call. All right. You would still have 60 left to go. All right. Because from 70 to 100, which is where you couldn't get any more trades, is 30%. And then from the 100, as it tracks downward to 70, would be the other 30. And that would give you an additional 30%. And that wouldn't mean that you would owe the broker money at that point, because he's got the margin set aside to pay your bill for all your losses. But, nobody really wants to get there. Like, who wants to, unless you're now, what can you do to increase the amount of margin? You can throw more money at it. Now, somebody would be like, why would I do that? It's already losing. Well, the reason we find ourselves in drawdowns like that, or one of the key points, is because we're being too aggressive with too small of an account. You heard Ryan and I say it last, I think it was Monday, why 2,000 is a better idea than 1. We're not saying, start a $2,000 account and trade more aggressively because we have more money. No, we're saying trade a $2,000 account just like you'd trade a $1,000 account, and you're going to be plenty safe. You're never going to see yourself in that big of a draw, in the larger drawdowns, because you still have the trading rules like it was a smaller account, if that makes sense to people. Okay, so the idea here is larger accounts. Remember, your floating P&L is the only money at risk at any given time. Just because you have 10 grand in there, if your floating P&L is 250, your 10 grand isn't at risk. 250 of your 10 grand is at risk, if that makes sense. So you could set it, Dr. K, you could set it to anything that you're comfortable with. But based on history, I have literally moved mine from 65 to 75 because I've been in like a 64.23% drawdown before. Ick. No fun. Bad day in the trading world for that. Okay, so that answers that. Let me make sure I don't have any other questions. You guys have been great with the questions today. Hopefully this has been of value to everyone. Let's see. Yep, that was me. Sorry about the default. Let me work on that to get that done too with him, so we get a better outcome. Okay, so guys, that's all we have for today. It's been a little bit over an hour. Hopefully it didn't bore everyone. Oh wait, Steve has his hand up. I don't know if he's. Let me. Steve, go ahead. If you want to unmute yourself, I did not see that. Is that something that you want? Was there something you wanted to say, Steve? Don't know that Steve has a microphone.
No.
Oh, nothing you want to say?
No, I'm learning how to use this whole
All
thing.
right. No worries. I'll lower your. I am too.
Great stuff. This is fun.
Well, I'm glad that it's providing some value for you. I will begin working on my content for Monday and Saturday. So, guys, thanks so much for your attendance on these Zooms. They mean everything to me and to Ryan as well, even though he couldn't be here today. We will. Don't forget about Thursday night. If you do have somebody that is looking to learn more about our AI software, I'll be doing a live event at 8:30 at fullthrottlezoom.com. Again, that's 8:30 Central Time, 9:30 Eastern, and 6:30 Pacific Standard Time. So I will work on getting this video posted for you guys as soon as I possibly can. Thanks, Gord. I appreciate the kind words. Everybody, God bless. Take care. Have a great rest of the day.